Today, I'm going to show you how I'm minimizing taxes and maximizing gains for my clients this week and how you can do the same. If you retire with a brokerage account, this strategy could potentially save you thousands in taxes. If your taxable income fits within the 0% capital gains tax bracket, you can avoid paying taxes on those gains entirely. At the end of this video, I'll share a powerful way on how to maximize both your tax savings and charitable giving at the same time. Quick disclaimer before we dive in, this isn't personalized advice, so consult your financial professional before making any decisions. Let's dive in. The first step is to review your investments inside of your non-retirement investment accounts. For example, I made a sample account here with several positions, and the cost basis means how much you put into that investment. The market value is what it's grown to today, and the final column is, of course, the resulting gain or loss. A loss may mean it needs more time to grow, and a gain may mean it's doing well and it's time to keep on holding on to it. I can't give you investment advice, but feel free to subscribe if you'd like additional education to find out how to make better decisions around that. As the great investing legend Charlie Munger said, the big money is not made in the buying or selling, but in the waiting. So that being said, the next step is to review which positions you are going to buy and sell. You want to know which ones no longer may match your investment strategy, and then we can start analyzing the tax consequence. As I tell my clients, I don't let the tax tail wag the dog. We're going to determine what decisions we're going to do first and then optimize the tax decisions after. So for example, if we know we aren't going to want to keep investments A and B here, we can sell them both, and because the first has a gain of 25,000, the latter has a loss of 20,000, we have a net realized gain of $5,000. If we were wanting to get rid of investments C and D, for example, because the first has a gain of 10,000, the latter has a loss of 10,000, we have a net realized gain of $0. Both of these situations, again, selling A and B and selling C and D, could lead to 0% capital gains taxes depending on your situation. A pro tip is that mutual funds will realize capital gains even if you don't buy or sell anything. They are self-managed funds where the portfolio managers within them are buying and selling positions, and they pass on any of those gains onto you. And it usually happens right at the end of the year and with not much notice, if any. So that's just one of the reasons I don't love mutual funds and don't implement them for my clients, because no one likes a surprise when it comes to taxes. What is also advantageous is if you have a net loss across your investments, you can use that to counteract against your income. Now, the IRS doesn't allow you to realize that deduction from a capital loss unless you've sold the investment and not repurchased it or something similar within 30 days. It's called the wash sale rule. This is different than realizing capital gains because you can realize a gain and repurchase it the same day without any sort of rules or penalties for doing so. Now, the next step is to see how these realized capital gains and losses affect your taxable income. I know this may look overwhelming, but please bear with me. Over here, I'm assuming that a couple in 2024 is filing their taxes, married filing jointly, and has a fixed income of $50,000, perhaps between their Social Security and pensions or what have you. And that $50,000 first gets taxed up to $23,200 in the 10% bracket, and the remaining amount gets taxed at the next tax bracket of 12%. After that, it's up to them to determine how else they're going to fill the rest of their 12% income tax bracket. They could take out more income from their IRA. They could realize gains from their brokerage account, which we're talking about today, or they could realize gains and withdraw the funds as income. The point of this graphic here is to say this entire orange bar right here is the opportunity zone for a couple to realize their capital gains with zero taxes. So there's no reason why a couple shouldn't be filling up this tax bracket, even if they don't need to make the withdrawals. If they can realize this much of gains and stay within the 0% bracket, then they will be saving thousands of dollars, depending on how much they would want to do. Now, keep in mind, once you do breach that $94,050 of taxable income, your capital gains start to be taxed. Again, this is different than being taxed at income rates, but this amount right here is going to be taxed at the 15% capital gains tax bracket. So for this example, to make the numbers simple, $10,000 over the $94,050 mark gets taxed at 15%, hence the $1,500 of capital gains taxes. Now, a pro tip to keep in mind is if you have not yet started your required minimum distributions, once you do, that's likely going to start spiking your taxable income. That's going to leave you less elbow room to take advantage of what I'm calling this opportunity zone of realizing capital gains within the 0% tax bracket. This is just one of the strategies you can take advantage of before RMDs start. If you're interested to hear more of these strategies, please subscribe as I'll be releasing more updates in the future. Now, a pro tip to get all the tax savings you can is to reference your Schedule D from last year's tax return. This is on your Form 1040, where if you go down to line 14, I'll zoom in here for you to see better. Line 14 has your long-term capital loss carryforward. What this means is you may have had a large loss last year or even a year prior to that, and the IRS only allows you to write off up to $3,000 of a net capital loss each year, no matter your income level. So if you've maxed out that $3,000, but you have another $50,000, then that would show up here on this line 14 of your Schedule D. So when I'm looking at my client's tax return, I'm saying, hey, if I see a $50,000 loss here, that's a nugget for me to say, let's go into their brokerage account and see where we can realize up to $50,000 of capital gains with zero taxes. We may not be wanting to sell off those investments and move away from them entirely, but at a minimum, let's trim the fat. So not if, but when we need the money in the future, we've already wiped away those gains without having to worry about the tax consequence. So that being said, step 6 is to continue to realize your capital gains in your non-qualified accounts until you A, max out all the gains, or B, max out the 0% capital gains tax bracket, making sure that you have not left anything on the table and trimmed all the fat you can. Step 7 is to navigate the capital loss carry forward wisely. If you're in the 22% income tax bracket or higher, it's likely better for you to maintain that net loss of $3,000 rather than to realize an additional capital gain position. Because if you're trying to save taxes at 15%, but you're in the 22% or higher income tax bracket, I'd rather take that $3,000 loss to counteract against the income tax bracket rather than just more gains. Let me know if you have questions about that. Now, keep in mind, not all gains and losses are graded equally. If you sell a gain within 12 months of purchasing in the first place, that's taxed as a short-term capital gain. That's taxed at income tax levels, not capital gains, which are much more favorable tax brackets. You have to hold an investment for over 1 year, 12 months, in order to qualify for these benefits I've been talking about today within the 0% capital gains tax bracket. If you have questions, consult your financial professional. I'd be happy to help if you have questions as well. Now for the bonus hack I promised. If you're already a charitably inclined person and you have capital gains in your accounts, consider making a donation in kind to nonprofit charities. It's where you take the investment and you donate it directly without selling it to the institution. They can take it, sell it off, and because they're a charity, they don't have to pay capital gains. And since you made a donation, nor do you. It's a really cool win-win to kill two birds with one stone and optimize both your giving and your tax strategies. With the year end quickly approaching, now is the time to implement tax planning strategies like the one we talked about today. If you want help maximizing your tax savings or other questions of retirement, use the link in the description below to schedule a quick call with me and we'll see if I'm a fit to help you meet your goals. If you learned anything today, feel free to like it so others can find it, and subscribe if you'd like to see more in-depth tax planning strategies for retirees. Thanks for watching, and I'll see you in the next one.